Welcome to Al Stock Trades, man. I am on fire today. I just had a 2 double concentrated coffee, and I'm ready to rumble. I don't know. It feels like a great day. It's cloudy in Arizona. It's really beautiful, and I'm wanting to go over. I haven't went over this yet, so this will be the first time me going over with you. I'm going to give you my thoughts, my analysis as someone with 10 years of experience in Wall Street and also in the healthcare field. So we're going to go ahead and analyze this 42nd annual growth conference for Canaccord Genuity. If you don't remember, I will remind you very easily. This individual by the name of Richard Close, the closer, he has a 59% accuracy rate and is ranked 207 out of the 348 analysts stacked up. His average returns are approximately 21.5%. Has a pretty funny smile. I like a smile. And he has Clover at $7. Sadly, we're only the highest price target out of all of them. But again, these are more short-term price targets. Again, Wall Street likes to basically work on 12-month spreads, which is currently a 138.9% upside, more than doubling your money at the current share price. So I believe this will be him conducting the interview, and he is going to be speaking to Vivek, which is the current CEO, pending January 2023, where Andrew Toy will be the next CEO in line. So yeah, I wanted to just kind of go over this. We're going to, if you can help me out, I tried opening up a StockTwits account, and then I posted one Clover link, and they said, no, you cannot post this. I'm like, okay, so help me out, post it on StockTwits. I have a hard time posting there. So I'm like, you know what, whatever. But we want to bring this out and bring this attention to a lot of Clover investors, because unfortunately, I hate to say this word, because a lot of idiots attached, a lot of retail, sadly, they put the word down, but there's a lot of FUD, unfortunately, surrounding Clover. I just saw a video of some guy saying, you should sell. Are you kidding me? Like the most dumbest person ever. Like, so just be careful what you hear. You know what I mean? You just gotta be careful. So grab a beverage, enjoy, sit back. This is going to be a live. So for people looking for a short video, we can summarize this on the next one, but this will be nice to go over and really do a detailed analysis on this video. So grab a beverage, sit back, enjoy, and let's go ahead and talk about a company that we all love and adore. Now, just to quickly, I'm going to make another video in the future about this, but since you guys are here, might as well tell you. So we are seeing a swift recovery in technology stocks. We are leaving the bear market territory, and it's the signal right here, as you can see. So anything above this is pretty much bear market. Anything below this is not. So we are exiting the bear market for technology stocks. We're going to see, we could rebound back up. But this is exactly what's happening right now. So you may be asking yourself, what? Technology stocks are recovering? Yes, they certainly are. And let me show you. So from our website, allstocktrades.com, we have this thing called sector rotation. This is a time period as we're on the 120-day, and we are seeing this green thing as technology. So I can eliminate it. I can click it. This is technology. And you can see here, technology has been going down, and then now it's finally going back up. Okay, now let's go ahead and remove energy. We can see that, this is why we advocated for energy earlier on in the channel in December of last year, but November actually. And then now we're seeing oil going down, but we're thinking it's going to rebound. But the beautiful part is we're seeing technology rebounding. Now let's go ahead and untrap healthcare. We're also seeing healthcare rebounding. Like I told you, healthcare and technology. Now look at it. Healthcare is number one. Again, technology is down, but that's just for the performance for the day. Okay, so overall, we're looking pretty good. Technology is rebounding. This is exactly what we want to see. Based off of some current analysis, we could be heading down towards another bear market cycle until we go ahead and shoot off, I believe, in next, to a very maybe short-term bull market until we hit a recession, which I think is going to happen. I think personally 2023, but we'll see. But based off of these calculations and what I'm seeing from the data I've analyzed, we're looking like we're probably going to get one more bear market dip, not as much as what we saw in June from the data. and it's looking pretty good. So there's that. I want to just kind of lay that to the side. We have our intrinsic value calculation. Sorry, that's the course. Let me. My apologies. We have the intrinsic value calculation fired up, ready to go, just in case if we need to do one when we go ahead and listen to this webinar. So I'm going to go ahead and shift this out of here. Please comment if you comment. This is your time. This is why I do lives. If you have any questions, comment them down below or whatever. I don't know how to the side, comment. If you are watching on your phone, find the comment section. If not, try logging on a computer so you can comment and be interactive. I do these because I want to speak with you guys. It gets kind of boring speaking in front of a camera without, you know what I mean? It's fun to be together. Okay. So let me go ahead and how do I exit this? It's been a while since I've done this here. So stop. Let's share, but I have to share the audio too. So there it is. There it is. So you guys see it, right? All right. So here it is. Now let me just go ahead and make sure the volume's good. Please comment down below. Clover's going to rip through this market. Just not sure when. Hey, absolutely. I mean, you have all this growth. Once the free cash flow catches up with the growth and the business model is solidified, people are going to be like, holy moly. They're going to be like, wow, I wish I bought more. I heard it many times. So let me just make sure the audio is good on my end. And then comment down below if you see anything, if you don't hear anything. All right, let's get started. I'm going to go ahead and put it at 1.5 times the speed. If you do need to hear it more slower, you can hit settings and adjust the speed to go lower so you can hear it the normal speed. Or if you want it faster, if it's live, you can't do that. But if you're rewatching, you can. All right, let's go ahead and put us on full screen. And wait, sorry, let's play first.
Thank you for attending. I'm Richard Close with Canaccord Genuity. Appreciate your time and coming to.
And he said Richard Close, which we already talked about, which is this gentleman right here. Okay, so we kind of, I pre-prepped you for this. Okay, all right, let's go. Well, yeah, one moon. Well, let's see. Let's see if we can get some hints and insights from the CEO.
The conference on behalf of Canaccord. We're going to shift now to an opportunity with the next generation technology platform aimed at the Medicare Advantage market. Today we have Clover Health, one of the fastest growing managed care, Medicare Advantage managed care companies. Also recently got into the direct contracting business, a new program with CMS that began last year in April. With us today,
So very quickly, I know I'm stopping it really early. That's exactly when I don't, not necessarily in April. It was actually in September, November. Minor error, but I came into this program, the stock, when I saw that direct contracting came online. I looked at the revenue. I said, you know what, this is definitely a great play. And I came actually after the squeeze, right? So I was like, because obviously I did not support the evaluations at the current time point of the squeeze. I felt like it was just because there was no direct contracting lives, right? So he hit it right on the dot. This is what makes this company special because they got access to that and now currently going to be called in 2023 ACO, which is for health diversity, which is exactly what this company preaches. Let's continue.
Have, and I had to scratch this out, former CEO or CEO to the end of the year and executive chairman, Vivek Garipalli, to tell us a little bit more about Clover Health. We also, from investor relations, have Ryan Schmidt in here in somewhere in the back there. So Vivek, thank you so much for joining us today. So you reported on Monday. Stock had a nice run up into the quarter, came off after the report a little bit. Market's been a little dicey as well. So, anything just in recapping the quarter to set the table before we dive into some of the, nuances on the business or the biggest takeaways that we should take away from 2Q?
Yeah, I think
and just very carefully here, let's go ahead and just go over and have the quarter up just in case if he references something, we can go in and remind ourselves how it looks like. And I want this to be very specific and very good for you guys. So I'm going to have the quarter here up. And if we do need a shift, we can go ahead and look at it. All right.
We've been pretty focused, I think, over the last year and will be over the next couple of years is ensuring we're getting closer and closer to profitability. So we saw a pretty big stepwise improvement on gross margins in our insurance.
I'm going to go ahead and rewind it. I want to know when he's saying profitability. Again, this is the first time I'm hearing this with you guys.
We've been pretty focused, I think, over the last year, and will be over the next couple of years, is ensuring we're getting closer and closer to profitability.
Over the next couple of years, as we get closer to profitability. So that actually worries me. I hate to stop the video, but this is important. He said, because I caught that as a way. Did I hear that correctly? He said, and I'm going to repeat it again, and I want you to tell me what's wrong with that statement. I'm going to repeat it again, and I want you to tell me what's wrong with that statement. There's something wrong with that statement.
Take away from 2Q?
Yeah, I think we've been pretty focused, I think, over the last year, and will be over the next couple of years, is ensuring we're getting closer and closer to profitability.
The next couple of years, we're going to ensure that we're going to get closer to profitability. Now, Vivek stated that we are going to go to profitability by 2023. Now, I told you guys, I think it's going to be 2024, later on to 2024, from my calculations. He said 2023. I don't know why. Tremont said 2023 when he first SPAC'd the company. Now, I don't know if that was like I'm just, maybe that's why they're doing the CEO shift. I think you're thinking he says later in 2023, but that's normally you would say next year we're going to be profitable. Next year we're going to be profitable. So that to me is a little weird. I think this is what's going to happen. And I've been in a lot of companies that shift from negative to positive free cash flow. I think what's going to end up happening is there's going to be 3 stages of profitability. The cash flow from operations will start to become, obviously in the positive territory. Then I think there's going to be a shift to free cash flow positivity. However, the net incomes on both of those are going to be negative. So technically the bottom line is going to be still negative. And I think the third stages of profitability is when the net income is negative and the net income is positive and the free cash flow is positive. And I don't think that's going to happen until 2024, 2025, but we'll see. This is where it gets dicey. They're going to have to, already I'm having some issues with this, but we'll see, because it contradicts what he says. And yet again, I understand that I had my calculations at 2024. I set my expectations. So the CEO should not have reset those for a lot of people. But again, I'm being hypercritical because, my money is on the line here too, guys. Right. All right. So let's see here. Let's go ahead and,
so we saw a pretty big stepwise improvement on gross margins in our insurance and non-insurance MCR of 1,900 basis points and 600 basis points respectively. Doubled revenue year over year, and our pretty meaningful reduction in operating expenses as a percentage of revenue, now under 9%. So I think kind of in the backdrop of the markets and a lot of volatility, the business that we operate in is generally immune to kind of economic cycles or inflation, supply chain issues.
So there you go. So he pretty much gave a hint. He said that our business is immune from economic disturbances, supply chain issues, recessions, X, Y, and Z, which is exactly what I told you guys. This is the type, again, I exited oil stocks. I was in Ernevav. I was in, Energy Transfer we're still keeping because, it's good dividends. But, we've exited those sections, ExxonMobil and all the other oil stocks. We put on the long-term price targets on the Al stock alerts here. But now we're entering an era where consumer staples, healthcare, and stuff like that is going to really, really be useful, but more specifically healthcare, because you don't cancel your healthcare.
Foreign policy risk and whatnot. So I think we're seeing some of that play through on the data side. And then I think importantly, kind of the crux of our business is Clover Assistant, which is our platform to help clinicians make better decisions. We can continue to see pretty dramatic differences in terms of the clinical value differential. So the members who see a physician on Clover Assistant versus those with a doctor not on Clover Assistant, it's a pretty material difference in gross margin.
Okay. You came through a SPAC process.
So essentially what he's saying is that people that go through Clover Assistant, the gross margins are different. And that's exactly the whole point of a technology company. If you go through the technology, it is going to be a lot cheaper for you. You'll be able to take more of that change from the money that you get in. Think of it like this. You have an Uber versus normal taxi company. If you go ahead and work, if you're a taxi company back in the day, I think they're all extinct now, but back in the day, becoming a taxi in New York, I believe a license to become a taxi goes anywhere between $500,000 to $1 million. And That's expensive, right? Versus now Uber is just like an app or something. And then now it just drives the cost, which means that a person that wants to start a taxi business, their gross margins are going to be a lot more cut than that, say, an Uber, who's essentially is a technology company and their gross margins are much more higher. So that's why I'm saying technology solves problems. In the future, you're going to, with Tesla, overall, right now it's still expensive, but overall it's going to get to a point where it's going to be cheaper to do it's going to be cheaper to own a Tesla car, because then you can go ahead and then have it drive itself with the full self-driving and have it basically taxi people. And then that could basically bring you money in on top of paying for the loan of the car if you go through that way, which is what a majority of Americans do. Okay, so I hope that helps in terms of the gross margins. Tech companies have better gross margins than a physical real world company. Let's say, for example, a REIT, a REIT company, or LP, different types of companies that I personally try to stay away from, except Energy Transfer, which I really enjoy. Okay, let's get back to it.
A little over a year ago, right? I guess November 2020.
Yeah, listed Jan 2020, or
Okay.
listed Jan 2021.
So, with that,
SPACs.
you mentioned Clover Assistant, and it's a technology platform, but you're competing against incumbent, much larger managed care companies, United, Cignas, whatnot. So, what's the main differentiation point for you? Why have you been successful in terms of the above average growth? And maybe talk a little bit more about the technology platform and how that plays a role.
Yeah, absolutely. So just taking it back to even why we started the company, we've always been focused on solving tough but important problems. So when you look at healthcare over the last 20 or 30 years, you've had a dramatic increase in the number of therapeutics on the market, dramatic increase in evidence-based guidelines and data that exists on how to navigate decision-making. Obviously, a multitude more kind of diagnostic tests.
I want to pause this. I'm so sorry but this is information that you guys need to know. So I was doing research for the time being, and I stepped away from the clinical setting. And I just posted a picture on YouTube about me finishing off telehealth in medical school. So what I did was I did research, and I at Mayo Clinic, and then dealing with some health things too. And then I came back to medical school, and it's like a complete shift. Like, holy freaking moly, with the whole COVID changed everything. And the things that they're teaching us now is like literally 30-40% different than what I'm being taught just a year ago. So you can see, like, there's a huge shift, and this innovation is literally bleeding into the heart and soul into the American medical school educational system that is essentially getting us ready to be able to take on this new technology, to take on these new platforms, in this new integration. And every single year, medicine changes. Every single year, we get new therapeutics, and it's so freaking hard to stay up to date. So it's nice to have a platform that helps us keep us up to date, and it continues feeding forward a software system that updates to help us stay on track, which is called evidence-based medicine, to keep us on track to this evidence-based medicine guideline, almost like, a meta-analysis, which basically takes multiple studies and does a statistical calculation to find the ever so truth of how to practice medicine the most efficiently in today's world, right? And Clover does that. And it's going to be so powerful. It's going to be so freaking easy for us to just go ahead and say, oh my God, oh, thank God. Oh, these are the new guidelines. And that's exactly what Andrew Toy was talking about. Kind of like how the Tesla is, how like you go in and you update your car, and all of a sudden the car has the right amount of updates, and you just haven't even changed the system because it's just a hard drive, right? And the software just updates. And that's exactly what Clover is going to be doing. And the beautiful part about these computers that we're using, the healthcare hospital system is going to update the computers to essentially handle the software, which is Clover. Okay, even if they didn't do that, they still have data centers and to be able to handle all that processing speed. Kind of like how there's a project at Mayo Clinic where they're taking X-rays and doing artificial intelligent deep learning algorithms and analysis to look at different tumors on an X-ray, and all they're doing is going from a Google Cloud little box under the desk, right? So I know I said I gave you guys a lot of information, but I'm just giving you my experience in the healthcare field as someone who is not just a I'm not a practicing physician. I am a medical student learning this information, and I'm literally seeing the changes in healthcare right before my eyes, and it is freaking amazing. Okay. All right, let's continue. I just wanted to give you guys that because it's experience that no one has. Okay. All right, let's continue.
Out there in procedures. But when we look at what physicians have in front of them to navigate through all this and make clinical decisions, a lot of the tooling is not really focused on that. It's very much focused on the administrative side or on the documentation side. So there's a very big gap in terms of what physicians are capable of in terms of harnessing their knowledge relative to what's actually presented to them to help them really think through what is the right next step or how to tune their intuition around what's most relevant. And where that gap is the largest is in the elderly population. So if you think about 65 and over, you have 68% of individuals have at least one chronic condition, 80% two or more. It's the highest per capita cost of healthcare. You have 10,000 individuals aging into Medicare every day. The fastest growing cohort or demographic in the country is 90 and over on a percentage basis. Yet that layer of individuals, primary care doctors, there's literally no technology that exists to really help them with the fundamental problem of navigating clinical decision making. A lot of technology is kind of the outskirts. And the reason is there's no actual way to make money giving software to physicians that help them make great clinical decisions. If you think about hospitals that generate more profit if their acuity level is higher and if they get to more dominant market share. EHR systems make more money, more from the documentation side or billing collections or charging for data access. Health insurers are more of kind of a cost plus type business model that's kind of been driven a lot of the market cap. So we looked at that and we said, well, this is a really big opportunity to solve a fundamentally important problem, but how can we build a business model that actually benefits from solving that problem? And then we looked pretty closely at Medicare Advantage, and we saw a bunch of interesting characteristics where everyone participating in Medicare Advantage was really focused on how to monetize the rules around Medicare Advantage versus using it as a vessel to build great technology and driving value the way the system kind of has been designed for. And so our approach was we have longitudinal data access in Medicare Advantage, so it allows us to see data coming through, any inputs that come in, and we produce information for physicians, how they interact with it. We're able to monitor to see what is the outcome of that. What is the action or non-action they take? And that allows us to tune our data platform internally. And then kind of the other side, which was really fascinating to us, is the accepted model in Medicare Advantage is to create a narrower network of primary care. What's unfortunate about that is we already don't have enough primary care physicians today. It's only getting worse.
So I want to pause this right now. It's very true. We don't have a lot of primary care physicians today. A lot of medical schools and state medical schools that are getting subsidized to increase the amount of primary cares being, in rural, getting integrated in rural populations, because this is a serious problem. What do? You want to go see your primary care doctor. So a lot of other practicing, I could call it allied healthcare providers, such as nurse practitioners and PAs, are filling in this gap, and we need their help more than ever. Nurse practitioners, PAs, and DOs and whatnot. We need their help, and even DOs now are specializing. So we need to really land on the shoulders of nurse practitioners and PAs to which obviously they're going to be using this platform as well. But it's amazing here is that in terms of this technology that they're looking at, the way they're integrating it is they've already established an ecosystem, looking at, like, for example, Cricket Health, right? If you guys don't know what that is, look into it. They're collaborating with them, looking at chronic kidney disease, and then going ahead and looking at Chamath Palihapitiya, who has another company that I believe he SPAC'd or invested in, which deals with chronic kidney disease, right? So you can see, for people that don't, understand the science, let me explain to you. As you get older, your GFR, glomerular filtration rate, what ends up happening is it basically starts to go down, and once it goes down, you get to your body builds up these normal proteins that normally would get excreted, such as creatine and different types of ions that unfortunately get built up in the system. And then if you have chronic kidney disease, you get a buildup of, unfortunately, these toxins that you would normally have to have a dialysis machine to kind of clear you out, and to kind of filter out your blood. the beautiful part about this is when you understand the elderly population and understand geriatrics, you'll basically have a concept map of, all the issues with cardiovascular disease, all the issues with diabetes, all the issues with cancers, and then colon cancer, mammograms, and then kidney disease. And you have all of this around you, and you build an integrated system that what is the Clover Assistant. And imagine imagine once you take in all that data and compute a concept map that helps you make freaking decisions, you understand how impressive is that going to be? And let's say a doctor in the middle of nowhere, 100 miles to 200 miles away from a city, literally with a population less than whatever thousand, having this technology at their grasps. Imagine the health and the life expectancy increase that's going to happen in that elderly population. This is going to be good for Native Americans. This is going to be good for so many people. And guys, this is really exciting. I don't, I'm looking at, this is extremely exciting. Okay.
For the next 10 years, yet the dominant approach is to take, let's say there's 100 primary care doctors, to kind of cut half of them and remove them out of the network. Well, the right solution we felt was, how do we take all physicians, those that are not in the network, those that are, and elevate decision-making for them all? And that was sort of the impetus for Clover Assistant. How that's turned into is a pretty simplistic approach where we allow any primary care physician to see Clover members. If you're in network for a consumer, it's $0 copay for you. If you're out of network, it's a $0 copay. So that would be considered just crazy for any other health insurer out there. But for us, consumers want choice. So if you look at the last 6-7 years, the HMO plans have actually been pretty stagnant. All the growth has been in PPO plans. We're a bit unique where not only are we a PPO plan, the cost sharing is also zero out of network. And what ends up happening is when an out-of-network physician starts seeing more Clover members, we'll go to that physician with Clover Assistant and we'll offer it for free. We'll simplify their payment model as long as they utilize our software, and then we get the benefit of that on the cost side. The consumer gets the benefit in terms of open choice. And for us, it's a pretty elegant way to deploy software without really having to sell it to physicians who don't currently have Clover members.
And maybe more specifically in terms of adoption of Clover Assistant, and we can get into some of the data on the better outcomes and better cost trends with Clover Assistant, but maybe getting the doctors to adopt it. When do you hit an inflection point on that? I know you changed some of the metrics this quarter, and you're thinking about what to provide the street in terms of Clover lives managed under Clover Assistant. But can you talk a little bit about?
So he said something important right now. He said, "I know you changed something, created a pivot on what you provide to the street, Wall Street." You remember how one of the like, hey, you used to give information about Clover Assistant, now you don't. They're making a big change right now, and that is a big deal. And hopefully they talk about why they did the change. And I think it has to relate to ACO, but let's see what Vivek says. Again, I haven't seen this video, so we'll see. So why are they losing patients? So for people that don't know, Clover Assistant dropped approximately 2,000 patients from last month to this month. That's equivalent to a 0.7%, which is less than 1%. So I wouldn't basically, oh my God, they're losing patient. I wouldn't kind of bang my head against the wall. However, if they lose another 2,000 and then next month they lose like 3,000, if they lose more, then I'm going to be like, okay, Bubba. Okay, Mr. Bubba, we got a big Bubba problem. Okay. But right now, 0.7%, I'm like, okay, maybe this is ACO. We're going to see the revenues are still growing. So we're going to go ahead and double check that. But we've adjusted the price, the growth to around 35%, rather than the 61 to 81% that we had them. So I've already priced in some form of a slowdown, again, because so I can understand the intrinsic value of the company, which is what we teach at AL's Mastering Stock Market course, part of AL Stock Trades. Now let's go ahead and continue. But that's a really good question.
Where you hit economies of scale with a doctor in terms of members, and how we should think about that?
Yeah. So once a physician has 10 or more Clover members, that's when we see the adoption rate, generally speaking, be around 90%. Meaning if we went to that physician, the acceptance rate, not overnight, but depends on if they're owned by a health system or independent. The sales cycle is a bit longer on the former. The reason that 10 has sort of been our magic number, an average Medicare patient sees their physician about 4 times a year. So if you assume a physician's working 50 weeks a year, they're seeing a Clover member then at least once a week. And so there's just this belief that they're seeing Clover patients. And that's kind of where we see that kind of inflection point. It does increase a bit more from there. But that's kind of where that stepwise, it's correlated with how familiar is the physician with Clover in the sense of does he or she have Clover patients. On the flip side, just from an ROI perspective, it doesn't make as much sense to us to deploy Clover Assistant if there's pretty limited Clover members with a physician at that moment in time.
Yeah, that's helpful. And then can you talk a little bit about the cost trends with utilizing Clover Assistant? I don't think you gave an updated metric other than saying, it's continuing to have lower cost trend for PCPs managing their members or patients with CA. So maybe just talk a little bit about that difference with the PCPs utilizing it.
Yeah, so we generally share the data kind of at the end of full year, just because we can get the full calendar year in. But when I think the last time we released it was at the end of 2021, it was about an 1,100 gross margin basis point differential between the cohort of members who see a physician on Clover Assistant versus those who see a physician not on Clover Assistant. And that's kind of the average. But the differential grows the longer
Big deal.
been on Clover Assistant. Don't quote me on this, but I think we had, for those who are on it for 3 years or longer, was north of 1,500 basis points.
Wow.
And what's really exciting about that is we're still in the early innings from a couple perspectives. One, we're still early on the integration side.
Guys, if this is true, 1,500 basis points, we're talking like, by 2026, this is going to be really amazing. I want to look at the gross margins and see how they increase, and we can calculate the gross margins with the percentage to see the positive, positive gross margins once all of them have been integrated over 3 years. I can't wait to see what's a 4 or 5 year look like. But for 1,500 basis point increase, that's better than what United Healthcare can do. This is extreme. There's a big chance that a lot of bigger chains are going to want to buy this company out. Definitely probably 4 to 5 times revenue multiple value. But from what it looks of it, Vivek and Andrew Toy don't want to sell. I mean, they're in it for the long run. They're in it for the next 10 to 20 years. All right, let's continue.
With EHR. So when we deployed Clover Assistant, it was as a true standalone platform where physicians were actively switching screens from their EHR to Clover Assistant. Clover Assistant is built fire ready in terms of interoperability. We've done our first integration with Athena, albeit kind of in the early stages in determining kind of the efficacy of it. And we're ongoing doing that now with Epic and Cerner. And as we improve that workflow, we're creating.
Again, they're integrating Epic and Cerner. So us at the University of Arizona College of Medicine, Tucson, Banner UMC integrated. We left Epic and we integrated Cerner, which is purchased by Oracle. And I'm actually doing my Cerner training right now. I have my, I do my Cerner. I can't show you because that's obviously patient privacy. But imagine if they could do the integration with Clover. Holy freaking moly. Oh, that's going to be amazing. And with Epic too, then you got Mayo Clinic under your belt too. And we already know Chamath Palihapitiya has a relationship with Mayo Clinic because Mayo Clinic uses social capital to invest their money in to essentially get a rate of return higher than the normal market value, which ultimately helps them remodel Mayo Clinic, and that's been done before. Okay, let's keep going.
A better ease of use for physicians, but what we call it really light integrations, where we really can still control the environment within which Clover Assistant is deployed. That allows us to control our upgrade cycle ourselves, roll out features at scale. One of the big errors that especially incumbent organizations make, they try to do these very bespoke EHR integrations, and you've generally kind of stymied the growth in terms of the value of iterating on that platform. And that's something that we kind of see time and again. Our whole belief is if you give physicians software that's valuable, you take their feedback, you keep improving it, pay them fairly, they're going to use it. That doesn't mean that they're all going to use it exactly how it's intended, but that's where the work comes upon us to keep improving that. So that creates a lot of upside over time. The second is we're still very early in kind of feature rollout. We've yet to roll out many features on care coordination, med adherence aspects as well. Right now it's very much focused on accurate diagnosing and treatment management. And so over the next kind of many years, I think you'll see kind of continued improvement in those metrics.
And just to very quickly comment on that, and that's exactly their whole platform in regards to the machine learning. There's different types of, there's artificial intelligence, machine learning, and there's deep neural learning. There's a lot of in terms of how AIs work, but the way Clover's doing it is a kind of a feed forward corrected basis where you get a bunch of data, the machine learning aggregates it, and then the physician goes in and corrects it. And the more corrections happen within the machine learning cycle, it learns better and it can become better. So over time, it'll basically not linearly, but exponentially improve. And I think that you're going to start seeing this after the 3-year mark from where they came out. So I think 2025, 2026 is going to be huge. But we're going to see if the science can correlate with the revenue and all of the numbers, which we are good at as we, I've been doing fundamental analysis for over 10 years, which is crazy. I'm going on my 11th year, which is insane, right? Time goes by fast. But that'll be very interesting to see. Okay, let's go.
Where you, as you bring in functionality, or are you able to do that on the fly, roll that out, or is it set times in the year where you roll out new functionality?
Yeah, so I think if just from like a versions perspective, we're probably just under like 100 quote unquote upgrade cycles we've been through. A small percentage is what we would call like massive upgrades. So for example, we just went to kind of like a V2 platform, which was like a wholesome. We built the first version of Clover Assistant. It was on our old infrastructure. We migrated it to our new one, which allows us to roll out features much more rapidly. The goal is kind of what we aspire to, is very frequent updates, not too dissimilar to when you're upgrading an app on your iPhone, as an example.
Okay. What about not providing the lives under management metric? What's the rationale on that? I just want to clear anything up with respect to that.
Yeah, so I think on the DCE side, what we want to do is clean up the numbers and really focus it on the insurance only side. So the feedback we've gotten is because when someone signs up for direct contracting, kind of by definition, they're on Clover Assistant, and it's a practice that we kind of sold to versus lives that have signed up directly with Clover. So we think it'll be cleaner in terms of just breaking out and showing Clover insurance only coverage and just rerunning all that analysis and breaking it out. Because when we think about that metric, that's the powerful metric that's really going to drive MCR over time. So, but I think the important thing is it's irrespective of anything, that number has been up and to the right.
Yeah. With respect to programs like the at-home program, you have different care management programs outside of, quote unquote, the PCP utilizing Clover Assistant, managing a member. Does at-home, you're utilizing Clover Assistant with that as well, right? And so that would be considered, potentially someone being managed by Clover Assistant in the future? Or is
That's right. So today we have about just over 4% of our lives are managed by a Clover employed primary care doctor.
Okay. So the above average growth in MA, how are you driving that? Is it just the attractiveness of the health plan, that the differentiation that you talked about earlier, or is there a method to the madness where you're outstripping growth of maybe larger incumbents?
Yeah, our growth strategy is extremely simple, and our marketing strategy is beyond kind of simplistic. So there's all these complexities you see with plans where they'll curate a narrow network. There'll be all these supplemental benefits, which I think is relevant in MA today. But what consumers really want is not to have to decide between choice in primary care or low cost. If you can give them both, you have a better product. And what you see with the large incumbents is you have to either choose between choice or lower cost. That doesn't make any sense. And if we think about kind of our growth model, it's let's give choice, low cost. Clover Assistant allows all physicians to raise their bar, and all physicians to be able to drive lower cost through better decision making. So that's kind of the mathematical component there. That's why a lot of our investment goes into Clover Assistant. And then we also think about the physician as a key customer. So when you think about other organizations, not only are they kind of narrowing which doctors can be their networks, so they're overnight kind of creating friction in the market, good doctors, bad doctors.
So just very quickly, I'm going to interrupt here and I'm going to say something. So in terms of the MCR, they're going to be shifting how they're going to be operating. So they're changing basically the infrastructure of the business, and that will definitely drastically decrease MCR, which will definitely lead them to profitability. The second thing he talked about right now was in regards to why are you're seeing this growth, you're leading industry average. So how there's industry growth, Clover's exceeding that. And it's like, you're obviously taking patients from the incumbents. How are you doing that? And it's quite very simple, guys. I mean, you just like what he said, you have to choose between low cost or choice, right? So what is choice? What is PPO? What is all that? So some folks in here may understand this. Some folks are like, I don't really understand it. Let me just basically print it out, make it simple. Let's say you want to see a doctor. You want to go ahead and Google a good doctor. And let's say you see this doctor with a bunch of freaking good reviews. And it's like, wow, I want this doctor. But the problem is your insurance company, you have a low cost it basically says, no, you can only see these certain amount of doctors. But let's just say, for example, you are, and I'm going to just give an example right now. You are an immigrant to this country. You speak a certain language, and you see a doctor that has a language, that has a name of your language or of your culture, or it looks just like you, and you want that doctor. Now, if you think that's stupid, no, that's not. That's actually backed up by research from the AAMC. How do I know? I'm in the healthcare field, right? Patients want to see physicians that basically look like them, okay, that come from the same culture as them. Denzel Washington says something really great. He said that, having a movie being shot by a black producer is actually relative and adds value to the movie. You can go ahead and study about black history all you want, but there's a certain culture that a black man or woman or them will understand, such as that, when you put grease on a hot summer day, that grease, that smell of that grease that you put on your hair to style your hair, that's the culture essence of, what it means of, being, like a part of the black experience. Right. And that's exactly the, what Clover essentially is trying to nail down, is to give patients of lower socioeconomic sectors a choice to see their own people, which unfortunately has been factioned within the healthcare arena. So that's a really big deal. There's a lot of culture that goes into this and a lot of research, and something that I'm personally passionate about. Because I am a first generation, right? So I hope that was helpful. Let's go back, and we're going to go to the questions.
The other thing that they do is when they have different lines of business, it's a Medicaid line of business or a Medicare Advantage line of business, commercial, you have all these different siloed parts of the health plan are kind of like beating up the doctors from different angles. We view the physician as a customer. So when we think about Clover Assistant, over time, we're excited, and we'll share more of this to come in coming years, is how to extend Clover Assistant across a physician's Medicare panel, beyond Clover MA and even beyond kind of fee for service on their behalf. So when we think about gross profit long term, it's not just gross margin of MA, but it's really gross profit across the physician, whether it's a hospital owned practice or independent. So long term, we're gonna win just in terms of kind of the operating cost structure versus incumbents. But we also have kind of a natural growth advantage because you can go to any primary care doctor, and that's what Clover Assistant enables. And even when we think about our home-based primary care program, it was a mathematical decision driven by us. So we studied a lot of the complex care models like Oak Street and ChenMed, Iora, and Kano. We think pretty sound clinical models. But what really kind of discouraged us around wanting to partner with them is while they have a big top of funnel, it's a very low enrollment rate from that funnel for two reasons. So one, there's very few patients that have 8, 10 plus chronic conditions that don't already have a doctor. So what happens is when they set up a center, they're taking patients away from another local doctor. There's nothing more violent you can do to another primary care doctor than take their patient from them and be in their local community. And the second aspect to it is a lot of patients aren't aware as to who they're getting calls from when they get kind of cold outreach, promulgated by the plan. So if, let's say, there's 500 eligibles in a market for that model, only about 100 are going to enroll. And so we took a very different approach, really to try to get to a much higher enrollment rate. So we thought, one, if it's home-based, then you'd have much tighter collaboration with existing primary care because it's truly not competitive. It's referral-based, so a primary care physician is willingly letting their patient enroll, similar to how they would refer them to an oncologist. And it's offered as a service to the member, so there's an understanding that it's part of the health plan. So our enrollment rate of eligibles is north of 60% in home-based primary care. Now, it's a small part of our population, I described 4%, but in any given year, that's over 20% of med access under that population. So again, that was kind of a mathematically driven thought process to create kind of harmony and coordination within a local market, but also get kind of a high matriculation rate. And I've seen this time again. I've been in healthcare for 15, 16 years. Every business that gets created in healthcare, it's kind of like it's this little silo. There's not a lot of thought as to kind of the implications around it, and kind of the disruption that it creates. But I think the other thing that's really important is if you put the physician at the center and the consumer at the center, you're naturally going to end up with better decision making as an organization.
So why don't we spend the last couple of minutes just on medical cost trends, because that's what drives the financials. So you had some improvement. I mean, there was some noise, relatively speaking, in the quarter, positives and negatives. Talk about medical trends. Your thoughts on medical trend expense, going forward, maybe with respect to the NA and then the DCE direct contracting, which is going to roll into ACO REACH at the beginning of the year. So just thoughts around that, where you see that going, or under a mature level, or maybe timeline to that.
Yeah, this is so on the Medicare Advantage side.
This is going to be important because now we're going to tie this into the financials.
Guidance that we gave for GAAP MCR this year was 95 to 99. First half of the year, we're under that, but we think it's important, given just a lot of the uncertainty over medical cost trends the last couple of years, to not adjust that guidance, given kind of thing that happened. I think the impressive thing in our results in the first half, it's being done at 3 stars. We think it's doable, even if we will be paid at 3.5 stars next year. We think it's doable to get to the mid 80s as a 3-star plan. Is the way we really like to look at kind of the map.
So I think they're looking at more to the 3 to 3.5 stars. 4 stars would definitely be great. I think maybe 4 stars, 2023, 2024, but we'll see.
of our business is to really look at improvement in stars as dollars we can put into plan design and benefits. So our kind of North Star is mid 80s at 3 stars, and hopefully we get there at some point. But this year, we'll be in the 90s, and we'll make kind of another material improvement, we believe, next year. On the BCR Reach side, it's definitely even though it's a very large kind of revenue line for us, definitely a speculative new program. It started, almost kind of got cut and then changed. So the exciting thing to us is it's empowering primary care, which we think is important just in general philosophically. For us, it's an unbelievable set of learnings for us on leveraging Clover Assistant, where we're not the actual insurer, but we're helping manage that risk and taking on that risk. And there's a ton we're learning, I think, in terms of improvements to make with Clover Assistant. We are seeing.
He said something important. Clover Assistant is not the actual insurer, but it takes on that risk. Essentially, a software that basically is directly can be employed to your healthcare systems, but then can be used with other insurances. So essentially, it's just almost like a middleman just to help you facilitate your patient needs, which is pretty damn cool. That means it's this can be literally be sold internationally if they really want to.
Lots of variations from market to market. I think a good amount of that is somewhat local benchmark related. So I think those, CMMI is probably going to review that and have to make decisions to ensure that all practices can kind of benefit from that. And then we'll look at all that data as well. But I think we now are in a pretty good position to set ourselves up for next year. We'll obviously see how the rest of the year goes as well, but we feel pretty good about making the right decisions for ACR Reach next year.
Well, we could have spent an hour talking about medical cost trends, but we are out of time. So I appreciate the discussion. Thank you very much.
All right, guys. So let's go ahead and let's stop the share screen here, and let's let's see. Let's do this. Let's go ahead and do a quick intrinsic value calculation here. So very quickly, I'm just going to go ahead and reload this just in case. Okay. And yeah, so let's go ahead and I said I'm going to have them grow at 35%. We're going to shoot at 10 years into the future. So you're going to see 2032 here. Okay. We're going to discount back at today's value to see the actual value of the company. Now, normally we expect them to be around, I don't know, 32, let's call it $3 billion this year. Let's have them grow at, we can be very conservative and have them grow at a 2.5%. All you got to do is just multiply this out. You would get around a cash flow of 75. Okay. Now, 0.25, that's like cheap, right? We know that, let's say by 2025, we know that they're going to make at least, we'll call it 45, 4.5 billion. I think that's definitely doable. And just to, just do the math really quickly, 4,500 minus 3, oops, sorry. 4.5 billion minus 3 billion divided by 3 billion. That's 50%. Divide that by 2. That's around 25% year over year. So that's obviously, I would say that's definitely doable. But if we do this and multiply it out by that, you're looking at 112. So we can go ahead and average them out. I think, I'm doing 2.5%. I'm being very, very negative here. I'm being very bearish. Like this is like really bearish. Okay, but again, I'd rather be extra bearish than, what I mean, just to make sure, because the market has flipped on us with the interest rates increasing, which means that growth stocks are not going to have that increase. So, based off of this, guys, I would say by the end of this year, because someone asked, where's the question? $10 when 2024. I would say, and again, this is just my, it's not financial advice. I'm not your financial advisor. This is just, again, part of the allstocktrades.com program where we teach people how to find values over stocks. And you can look at our success record with Tesla, AMD, and Box, and all these other things that we've been doing, ExxonMobil, and all those other stocks, and Phase, and all that good stuff. But what I want to basically say here is, I think by the end of the year of 2022, going into 2023, I think we're going to hover anywhere between $4 to $7. Okay, $4 to $7, which goes right in line to what this person, what this individual from Canaccord Genuity basically talked about today, and his price is $7, right? So you can see kind of where he's getting this from, and he's probably doing this and being very bearish. Okay, and this is growing at 35%. Now, normally, if I would say to be extra, let's not be bearish. Let's be reality here, and let's do 5%. We're looking at 150. Well, let's actually take the average here. We can or rather just take the average here. What is it? 150 plus 225. 150 plus 225 divided by 2. We're looking at 187. We can hit a 187 here. and then we could do 25%. I think 25% is good. And again, you're still getting this crunch out around this. I'm being extra bearish. I mean, come on, we're saying that this company is going to grow 25%. I don't, if this company can sustain a 55% growth rate, then it's going to shoot once it becomes profitable. But again, I want to be extra bearish. And then next year, once they can, let's say if they can beat their $800 million quarter over quarter, year over year, if they can beat that, then imagine we're going to be raising the price target, because then now we're starting to see that this company is just so focused on growth. And it's very clear because they're only in a couple of states. So in comparison, we have 50 more states to go. Not 50 more states to go, 50 minus the number of states if you count Puerto Rico. And then imagine that Clover Assistant can be sold in other, Canada, China, and all these other places. Okay. And they already have a kind of a baseline in China too. So this is it right now. So I personally think my price target is $25 so far on the company, and we decreased it from 48, and still $25 is 600 from the current share price, 600%. So I hope that was helpful. Let's go ahead and answer some questions here. I think the Fed guidance for June's QT was completely false, and Fed spreadsheet hasn't been unrolled yet is the problem. So yeah, this is why I'm being a little bit more harsh on the company, because the Federal Reserve now is basically, they might pull a semi-Paul Volcker, and that's going to basically be devastating for growth stocks in the short term. They're looking like they're going to continue increasing rates, even though inflation is still going down in terms of the CPI, because they know the CPI is a lie, CP lie, right? They know that I think the real inflation rate is if you just look up, I'm going to give you a trick. Watch, look at eggs, increase year over year. Let's look at egg prices. Give you a trick. Like, do we know the percentage of eggs prices, how much they've increased? Well, let me just give it to you. It's around 22% over like butter and stuff like that. So if we do 22% and we take 75% of that, on average, I think the real CPI, the real inflation rate is 16.5%. Okay, so that kind of gives you guys an understanding of like kind of where inflation is. So I think they're going to have to keep pushing. And even if the inflation does go down, they're going to keep pushing, keep hitting it, right? And I think that's definitely, I don't think the Inflation Reduction Act is going to reduce anything. It's not, I think this is a BS name for it. But definitely that is a kind of the short-term bear of what's going on. And I think that's why I'm being hard on the company here. But regardless, once they become profitable, this is a healthcare company and it is immune through economic activities. Okay. All right, let's go ahead. It's just because it's a SPAC that a lot of people have been hitting it hard. Okay, let's go ahead and keep going. I would assume a $2 support level should hold through. What's coming is its best outcome right now. I don't think the $2 support level is going to be found. I don't think we're going to get at June lows. That's my opinion. If I'm wrong, great. That's amazing. I mean, I hope it happens, but I just don't think it will. I think the next level of support is anywhere between, like I said earlier on in the video I made for the earnings, anywhere between $2.50 to $3.10. I think that's going to be the new support level range. I don't think we're going to get down to the $2 anymore. It's going to take a lot to get to that level. No. I love hearing your guys' opinions and thoughts. I'd say that very valid if the overall market can hold together. Absolutely. If they aren't adding patients and they aren't licensing software, then how are they adding revenue? Yeah, so that's essentially with them being a little bit kind of is a good test to their MCR. Again, they kind of group up MCR together, which kind of gives you the 90% plus. But if you would parcelate it, and I wish they did this, they used to, but they just they do it every year, I believe, on their annual 10K report, right? But what they do is you can parcelate patients based on how many years they've spent with the Clover Assistant, Clover Health platform, and you can see that patients with the 3-year versus the 2-year versus the 1-year, and the more 3-year they have, the more gross profit margins they get to take from that. So I hope that makes sense. Hello. I think we're getting closer than we were yesterday. A little late to the party. Oh yeah, no, it's all good. Revenue is not why I buy Clove. It's the growth mainly because revenue for the biggest names on the market are likely to fall apart. Growth will be only real investment out there. Well, yeah, and also technology as well. You know what I mean? Technology. So yeah, Just to kind of do a quick plug in here, we do offer L stock alerts for people that don't know this. This is a bunch of like, for example, you get access to all of this. Like, for example, if you want to do Clove and look at the Fibonacci retracements here, you type that in and it pretty much gives you a free tracement Fibonacci sequence, which helps because it gives you kind of the support levels of where Clover could go. And it looks like 290 is the support level here. Then we have 270, then 245, then you have that 205. And you can use this along with our stock research. We have dark pool data. We have options flow, algo flows, and obviously crypto, more charts to help you. We have artificial intelligent bullseyes to help you when to get calls or puts, when to buy stocks. There's just so much that we have here, short volume, and we have our very own proprietary technology, Brain Machine, which is really more geared to fundamental analysis and also some shorting. So we have a great community. So there's just a lot that we offer here. Heat maps too, directly from our Discord. I just wanted to plug this in because it is something that you cannot find for under $12. It's something that is very difficult. We price this purposely because we're not making a profit. We're just keep reinvesting in. And also we have our Mastering Stock Market course, which includes our stock alerts. So that will be a link down below. I'm very proud of what we created here. And I'm going to, this for me, I'm going to put in like 10 years of work into this even more. And it's just going to get better and better and better and better. And it's going to get to a point where you're going to be able to invest and see what in a professional like myself, that's going to be a physician who's marrying a physician who essentially is future physician, right? Who's going to be investing in how we're going to be building our money through that way. So it's a great way to connect. And there's a lot other people that have six figures on our Discord, and they're going to soon to be seven figures very shortly. So it's going to be a great way, and they're highly motivated to help. So it's a great community, which you can't really find that. And majority of people that have the money, like sadly in this region, and I've been to those places, they're a bit stuck up, but we are not. I tend to attract people that are humble and want to learn, so that's great. Okay, so I believe in the new CEO will make the oh, absolutely. He's a technologist. You want a technologist leading a technology company. You know what I mean? That's why I was like, Vivek, I was scratching my head. I was like, why is he leading this technology company? What is this guy doing? Get out of here. No, I'm just kidding. But Andrew Toy's the right choice. It was very clear. It's a good company with valid needed products, but I do believe I'm going to be holding for a while. No, of course, you're going to be holding. And that's, the whole market that you guys came from 2020. Listen, guys, everyone made money. I made good money in that market, right? But, I understood that overall, this is not going to last. Okay, this was free money, and money was injected within this. This is Fugazi, Fugazi money. This is not real. Okay, the real stock market takes literally 4, 5, 6, 7 years to make money in. And if you're committed and if you want to make that money, come right in and learn from us, and we'll help you how to analyze companies. But if you want that quick cash, we offer that too. It's called short squeeze stocks. We have it really well. We've called out Bed Bath and Beyond in July 26th. So we've called it out when it was $4, right? But to understand that should be only 5 to 10% of your portfolio. And that is directly from The Intelligent Investor by Benjamin Graham, saying that 10% of your company, your portfolio should be in speculative stocks. Okay. So anywho, I hope that was helpful. I love each and every one of you guys. This was a good breakdown over Clover Health. I think this was very good. And just a very quick announcement. We will be starting our bi-monthly meetings in the Al Stock Alerts and Mastering Stock Market platform, to where we will create a poll of all the stocks that you guys want, and you guys will vote over which stocks you want me to analyze. And every 2 weeks, we will be analyzing in on a group chat video format on our Discord live stream, not on YouTube, on our Discord. So if you want a company for me to sit down and analyze, look at the financials and everything like that, then we'll be doing that. Because I've seen a lot of people, hey, Al, can you analyze this? Hey, Al. And I'm like, how can I do this in a way? And I feel like, we can add this to our platform, and I think it'll be a good feel, because then you'll see how I use our platform, and then it'll be beneficial for you. So anywho, that was very helpful. I got one more comment here. 100% agree. $2 will never happen again. It's over and done. And with Toy in the driving seat, great things ahead. Yeah, and if it does happen, amazing. It's kind of bittersweet when he said that we're going to be profitable in the next couple of years. One is, hey man, you said next year. You know what I mean? My calculations at 2024. You could have just given it to us straight. Maybe that's what he meant. Maybe he's nervous. He sounds like an introvert to me. But another thing is, it's great because if they're not free cash flow positive and income positive, the stock will always be traded under value, which is great because then you can average down. And I think I'm going to stop buying at $4, $4.50. I'm done. Maybe $6 to push it, but past $6, I'm not a buyer anymore. I just want to ride the growth. I want to look at other companies. I hope that makes sense. Okay, guys. Hey there, critter. That's a funny name. I'm a little heavy at 16%, like waiting for the opportunity to get to that 30% and then distribute. Yeah, absolutely. You can cut and you can go ahead. That's what I'm doing. Cut and then go in and pick other stocks and do your thing. The goal is hopefully this can become free cash flow positive before Palantir and other stocks become free cash flow positive and then income positive. That'll be great, right? Then you can ride the growths over those companies. All right, guys. We're going to go ahead. I have an AMC video I'm going to be making. It'll be a nice and fun one. A lot of prominent YouTubers out there are saying, hey, the squeeze is over. So I want to respond to that, and I think it'll be great. Okay? There's a YouTuber. My name is Lou. He goes like this all the time. Literally. The AMC greatest financial analyst. Look him up. All right, guys. Peace out.